your conclusion in your latest report out
Absolutely.
today. But the FSA, when it came to the banks, we could be even more furious with them for this.
Absolutely, both on the big and the small scale. On the individual product, 4 years ago we were expressing concerns. Only now is anything being done about it. And as soon as Northern Rock appeared, there should have been direct intervention by the regulator. Both here and in America, the regulators utterly failed. And it's due to this feel that the market will come right. And the obsession of government and regulators about light touch regulation. If the regulation is needed, it needs to be enforced heavily, and that they failed to do.
Consumers, small businesses, they feel let down. What's the message that's coming up through
Well, the message
to
is coming back is that they've lost trust and confidence in the financial system, and that is a very dangerous situation for the economy and society as a whole.
Larry, we'll speak to you with you later in the programme. Thanks for those thoughts. So how exactly does this huge insurance policy that RBS is definitely taking advantage of and is taken out from the government actually work? Here's Dominic Laurie to explain.
In an era of financial record-breaking, we could have another one. Is this Britain's biggest ever bailout of a single company?
We're offering insurance of about £325 billion of assets. These are things like commercial loans or mortgages which are worth less now than they were perhaps a few months ago, but which we hope will increase in value as we get through this recession.
This all works a little bit like a giant car insurance policy. Basically, whenever I go out for a drive, I know that if I have a really bad accident, my policy will cover me. Yes, there's an insurance premium to pay at the beginning of the year, and also some costs of excess in relation to an accident. But beyond that, I'm done. I'm covered. I know an accident won't bankrupt me. RBS has identified £325 billion of vulnerable assets that could go bad. They need to insure against that risk. In the event of a financial accident, RBS shareholders take the hit for the first £19.5 billion. That's the equivalent of their policy excess. Losses over that, though, we don't know how much, will be borne by the taxpayer. Yes, that's us, the insurance company. The premium RBS pays us in return is £6.5 billion in shares.
The object of this is to provide that certainty and that confidence that will maintain lending, and that's essential for each and every one of us, whether it's individuals or businesses.
If those future losses never happen, the taxpayer will have got a whopping fee for no downside. The likelihood, though, is for some time to come, it's us who'll be bankrolling RBS, not the other way round.
Let's get some more thoughts from Jonathan Compton from Bedlam Asset Management. You know, today we heard from Mervyn King, the Governor of the Bank of England. He said it's impossible to tell how much capital, how much more money the banks will need. You know, Royal Bank of Scotland, £325 billion. That's just one bank. Already we're hearing when Lloyds Group, they report their results tomorrow, we're already concerned about how much more there's going to be. This is just a bottomless pit, isn't it, by the government?
Yes, it is. It's a bottomless pit. And it's in the case of 3 or 4 countries, which Britain stands out, along with Ireland and 1 or 2 others, the amount of gross banking assets compared to the size of the economy is just enormous. You've got 2 banks in Britain, Lloyds and RBS, which are bigger than the British economy in terms of gross assets, which is an important word to caveat. And he's right to say he doesn't know, because to give a number is foolish, OK? He's already decided, and the Bank of England has clearly decided to go for what they call monetary easing, which actually is printing like crazy. It's issuing a lot of money, OK? But there are a lot of losses to come, and what Parliament and the Bank of England are still doing about, some losses have to be taken. Now, what they're trying to do is smooth them over 10 years rather than 10 weeks, but there's still some horrendous losses to be taken.
You know, we call these assets toxic. They're toxic now, they're no good now. But perhaps in the future, years down the line, we could be at an advantage with this unit that the government's created.
Oh, hugely. We could be at a huge advantage, and a lot of these so-called bad assets will turn good with time. So it could be a big advantage. The problem is governments are not very good at regulating banks, as Lord Whitty was just saying. They're not very good, actually, at directing banking. So you do want to have the government out of the banking system the next 3 or 4 years. The risk is they're going to say, what fun, we control the banking system, let's keep control.
Jonathan, thanks for that. Time now for a little bit of extra news now. House prices fell